Welcome to the InterMarket Analysis video update. This is a video that I do once a week where most of my focus is on the S&P 500. Well, we also look at other indexes and other sectors within the stock market, but then we also look at other markets. We look at commodities, we look at precious metals, we look at the dollar, because sometimes we can get some clues by looking in other markets, and that can help us have a better insight and understanding of what's actually happening ultimately in the S&P 500. This is being prepared for Monday, November 20th. The first area that we look at is just within the S&P 500, and we also look at mid caps and small caps with a thing called valuation. Every company has to make earnings, and then those earnings translate into profits, and the earnings that are generated by a company ultimately justify a stock price going up or going down. Well, there's a couple of different ways we can look at this. We can go back and look historically at what were the official earnings reports that came out compared to the current price, and then we can track that through time. And then we can also look forward, and this is based on analyst projections and forecasts for what a company should be earning somewhere down the road. Now, we look at the historical values because that gives us some perspective. The market looks forward, and that's what justifies prices going either up or down. And then we can use that right now to get a good idea, where is the market valued at this time? The first is by looking back at a thing called TTM, or the trailing 12 months. Now, how we do this is we do a ratio, and then this ratio is put on a static scale. 10 or below means the stock is inexpensive. Between 11 and 19, or if we hit the middle there, 15, the price is considered to be fairly valued. If it's at 20 or above, it's considered to be expensive. Then we can plot this with the green, red, and blue lines here, and then put the current price of the S&P on a chart. And right now, we see the S&P, which is in black, it's well above the PE ratio of 20. So on a historical basis, we are considered overvalued at this point. But we can stay this way for a long period of time, and it doesn't necessarily mean that the market's going to fall apart right away. On the bottom is just the spread between the current price of the S&P and the PE ratio of 20. When we're above this blue line, which is 0, that means that price is above the expensive level for the PE ratio. We can also look at this in a historical context with different events that have happened and what the valuations were at that time. And then there's another thing that takes more of an average over a period of time called the Shiller PE ratio. And this was developed by Robert Shiller, where he has his own way of looking at the PE ratio that is becoming more and more popular. Sometimes you may know this as CAPE, C-A-P-E. The reading that we get based on his calculation right now is at 30.56. Well, to give us some perspective, we can look at a historical chart and see that we're above where we were back in 1929 before the big stock market crash. We're well above where we were back in 1987. So you would think, oh, we should freak out about that. Well, as I said, this can last for an extended period of time. To give us more of a perspective with how it applies to this chart, we look at the mean and the median here, and the median is just under 16 at 15.95, where the mean is just a little over 17. And right now we're getting a reading at 30.56. So again, looking historically over an average period of time, we're also historically expensive right now. But as I said, the market doesn't use it that way. They look forward, and we have a number of projections that we can look at. These are called forward PE ratios. And as of Friday's close, the S&P 500 is coming in at 18.7. We're below that 20 level, and we're above the 15 level. And that's why the market can justify going up from this point unless it decides it wants to go down. We also keep an eye on the mid caps, where they're coming in at 13.4. That's under the 15 level. And small caps, which saw a little bit of a bounce this past week, they're coming in at 12.7. So you have the small caps and the mid caps, which are more fairly priced, and then the S&P, which is kind of expensive, but not necessarily extreme expensive when we look forward. We can plot all of these on the same chart just to give us some perspective here, and in different colors. They tend to move in the same general direction. But then when we're looking at small caps, there are two main indexes that are very popular. There's the S&P small cap index, and that's the area on blue. And I use that when I'm looking at PE ratios because that lines up with the 10, 15, 20 scale. There's also another small cap index called the Russell 2000, and that's what's plotted in red. It's a bit different on the scale here, so it doesn't really line up into our PE ratios. Another area that we can look at is growth to value. When you want to buy low and sell high, those are growth stocks. When you want to invest in something that may hold up better if the market runs into some difficult times, or maybe a stock that pays dividends, or maybe a stock that's been around for a long time and you have a lot of faith in that company, that might be considered more of a value company. Well, when the market's really going up, growth tends to outperform value. In 2022, we ran into some really downward moves, and so value was outperforming growth. So we want to keep an eye on that. But the first thing that we look at is just a growth index. And this has recently generated a death cross here, where we see the blue line is below the red line as it's been chopping more or less sideways. Then we also look just at value, which is continuing to be in a downtrend, even though it has been bouncing up throughout the month of November. But then where we get some insight is when we compare the two with each other. We do a ratio. And on the top, we have a growth to value ratio showing how growth has been outperforming value, even though it's pulling back recently. And then we look at an inverse of that same chart showing how value is underperforming growth. Now, the reason why I look at a number of different charts up to this point and then after this is that we're looking at indexes, ETFs, and different sector evaluations of things. And we can get some different calculations. All of these are calculated just a little bit differently. And you can see right here is a kind of an example of that, where we saw a crossover with the growth to value ratio after we saw a crossover with the value to growth ratio. We just want to make sure we're seeing the same things at the same time, because if you're doing really large shifts from one to the other, you want as much confirmation as you can get. Here is an ETF showing how growth is outperforming value. And here's an inverse showing how value is underperforming growth with the ETFs. Then we look at some other index charts here showing how growth has been outperforming value, even though growth has been coming down in this ratio. And then we look at value to growth, a little shorter term chart showing how value has been underperforming, even though it's been bouncing back up lately. Then we look at the other indexes showing that growth continues to outperform value, even though it's been pulling back. Then we have another measure using ETFs where we take a growth to value ratio, and this is actually looking more positive. And I've been showing this chart in the daily videos where we're actually breaking out above these previous high levels here, and we're well above this rainbow. Even though we pulled back a bit in Friday's session, it still has been advancing. Then we look at value to growth, which is an inverse of that chart we just looked at, showing how value is underperforming growth and under the rainbow. Then we keep an eye on the different indexes. Here's the small caps, and we want to look at growth to value with the small caps and take that ratio where we've been chopping more or less sideways, even though we're still in a longer term uptrend. We have seen some recent strength here, but it has been pulling back over the last few trading sessions. We also keep an eye on mid-cap growth to value, where that's also in a longer-term uptrend. It's actually holding up a little bit better, even though it ticked down a little bit in the past week. This is the one that I hone in on the most. This is S&P 500 growth to value and taking a ratio of that, where the index has been going up, but we're seeing this growth to value ratio actually going down. And that's a warning sign to us. Other times when we're seeing the S&P going up, we want to see the growth to value ratio going up too. We're not seeing that necessarily right now. There's other positive things that we can be aware of and that we can latch onto, but to turn more positive on the S&P, we want to see this ratio go back up. Some inflation gauges that we look at. We have the CRB index, which is commodities or are commodities. And we look at a monthly chart on top, and it is pretty much going sideways right now, but we have been seeing some weakness. There's been some talk of deflation, which kind of gets more into the chart down below. Inflation is what the market seems to be fixated on, and it's what most of us are used to as prices are going up and up and up. Well, believe it or not, deflation is actually worse than inflation. You might think, well, yeah, price is coming down. Well, the wave effect that can have in an economy where companies cut back, they lay off people are locked into mortgages that they can't pay for because the value of their houses have gone down. The whole thing, it can really create a much more devastating situation, as we kind of saw, well, we kind of heard about or learned about in the 1930s with the Great Depression. And this ratio is continuing to go down when we compare inflation to deflation. Not necessarily a concern right now. This has been going down here for a while. It's when this really starts to go down, that's when we get more concerned. We look at the CRB index by itself. where it is in an uptrend, but it has been pulling back as we're seeing a bounce in the stock market. Then we look at the Baltic Dry Index. What does it cost to ship products from point A to point B, specifically in the Baltics? Now, there's a lot of people that put other charts on here and they shift it forward and they do all this magical work on a computer to try to figure out. I just look at the straight chart and if we're in an uptrend or a downtrend. Now this, even though it has been pulling back, we are in an uptrend with this, meaning that it's costing a bit more to ship products in the Baltics right now. So we just want to keep an eye on that. It really spiked up back in 2021 and then has been coming down. Now it's starting to go back up. This could be inflationary. Some other markets, we don't trade these markets. We just kind of keep an eye on these markets just to see what's happening. If most of these areas in these markets are going down, that's more deflationary, or if they're going up, that can be inflationary. And in aluminum continues to be in a downtrend and has been for a while. Corn is also going in a downtrend. Wheat is in a downtrend. And then we look at fertilizer. You got to have fertilizer. That's kind of where everything starts when you come to growing things. It had been coming down in price, and then it was starting to go back up, and now it's starting to taper off. We look at oil. This is something that impacts all of us, where we have seen an overall uptrend here, but oil has been pulling back. Now, some of this had to do with some reports out of Saudi Arabia and Russia that they were cutting back until the end of 2023 with their production. That really pushed it up. Then we started to come back down, and then we had the whole Israeli geopolitical situation develop, and that was pushing oil back up again. But since that time, it has been coming back down. So it's been pretty choppy lately. Then something that you probably feel every time you fill up your car with gas is we are in a downtrend now when it comes to gas. We look at diesel because we have 18-wheelers and trains. They use diesel to ship products back and forth. The more they have to pay for diesel, the more they're probably going to pass that cost on to you. Where it has been declining, then we saw diesel going back up. Now it's starting to go back down. Look at heating oil, starting to get kind of cold now. So it's kind of nice that this is going down, but it's still in a longer-term uptrend. Natural gas, also a big source of energy that we use. It had really fallen, starting to come back up, and we are actually in an uptrend with this. Copper, this is a barometer of the economy. Typically, as a general rule, when copper's going up, that looks better for the economy going forward. When copper's going down, that suggests a weak economy. Well, it's in a downtrend now, and we're seeing that same thing on the weekly chart. So that's suggesting that we're seeing the market anyway is anticipating economic weakness into the future. We look at copper to gold, because when we're in a high inflationary environment or a high unstable geopolitical environment, gold has a tendency to do quite well. When we're in a better economic environment, copper has a tendency to do well. Well, we are seeing that copper's underperforming gold with this ratio, but it has been bouncing back. Gold has been pulling back as copper has been seeing a little bit of an outperformance lately, but it's still underperforming in the long term. Here's a long-term chart of that same thing, where the black area, that's the copper to gold ratio. And then to get an idea, we look at interest rates. We have the 2-year yield and the 10-year yield, and these are still really far apart from each other. We're kind of shifting in the economic environment because for a long time, we tended to see them go in the same general direction. They also, even though they're on different scales, tended to not get all that far apart from each other. Well, if you look over way on the right-hand side, we have a really wide spread here. In fact, we have inverted yield curves when it comes to interest rates, and the copper to gold ratio has been going down, and this might suggest some kind of a longer-term shift economically. We don't really know what to do with that right now, but we just want to keep an eye on this. We look at gold, which is still in a downtrend. Now, it really started to go back up as things exploded in Israel. It's been pulling back, but then it saw a little bit of a bounce up in the last few days this past week. Silver also is in a longer-term downtrend. It was also starting to go up as things broke out in Israel. Then it went sideways, fell down, and now it's starting to break out above its moving averages, but still in a longer-term downtrend. We look at the closing value, the end-of-day value with gold on the top and then silver in the middle. And then we just look at the correlation between the two, where they're having a pretty strong tendency to go in the same direction at the same time. Now, they could both be going up or both be going down. And this kind of only goes to logic, thinking, well, if gold goes up, silver probably goes up. That's not always the case. Sometimes they get unhinged from each other, according to this chart. And it was weakening a bit in this relationship, but lately it's been getting a little bit stronger. And we have a general observation that we can also make. We look at the gold to silver ratio on the top. When this is going up, that means gold is outperforming silver. Again, they both could be going up. It just means that gold's going up even more. And then in the middle area, we look at the US dollar index, and we see that there's kind of some similarities here. And we can take some general observations from this. When the US dollar index has been going up, and that's what it had been doing, even though we've seen some recent weakness in the dollar, gold outperforms silver. All right. And then when the US dollar index is going down, silver outperforms gold. So if you are into precious metals, this might be helpful to kind of guide you. Maybe there are times you want to be in gold, other times you want to be in silver. Maybe you just go ahead and spread it between both. But this can just give you some insight as to what to do. And then on the bottom, we see that the correlation between the top chart and the middle chart is quite strong. The dollar, which is still in a longer-term uptrend, even though it's been pulling back. Now, if we're going to see more follow-through upside action with stocks, it's likely going to come at the expense of the dollar index actually going down. The stock market likes a weaker dollar because of import-export reasons and because of conversion rates. So if this was to fall, that might give some support to stocks. As we've been going up throughout the summer months, that's when the stock market really started to go into some problems. And now that it's starting to go back down, that's seeing a little bit of a bounce so far anyway with the stock market. Then we look at the euro to the US dollar index, where the euro's been coming back. They almost got to a parity level, which means that they were like 1-for-1 with the exchange rate. Then we also look at the Japanese yen, which is still really underperforming the dollar. And I have individual charts. Here's the euro to the US dollar, which it had been really showing some weakness. So the first part of October, that would have been a good time to come to Europe because they were getting down to almost being equal with each other. The euro is still underperforming the dollar, but we are seeing the euro show some strength as of late. You want to go to Japan, you'll probably get a pretty favorable exchange rate. It's still in a downtrend when compared to the dollar. And the British pound is also in a downtrend, but it has been bouncing back if you end up wanting to go to England. We look at some different indexes. We have the equal weight index, where the S&P 500 itself is a weighted index. So the big mega caps, if they're having a good or a bad day, that can really influence the index itself. Where the equal weight index, it treats all of the stocks in the S&P 500 the same. And when the red line is below the bar chart, that means that the broader market is underperforming the S&P 500. Now, this has been making a nice little bounce lately, but we would like to see this red line actually get above the S&P 500 line or the bar chart. That would show that we're seeing more broad participation within the stock market. We also look at a ratio between the S&P 500, which are stocks, of course, and then the CRB index, which is commodities, and we're showing that stocks are outperforming. Now, we did see a recent death cross here with this ratio, but with stocks doing better than commodities lately, if we can stay above both of these moving averages, we might see a golden cross with this ratio. And we look at an inverse of that same thing, where it shows that lately the CRB has been underperforming stocks, but in the longer term with the trend, the CRB is outperforming. We look at the NASDAQ 100 and compare it to the S&P 500. Both have been doing quite well as of late and in 2023. It's just that the NASDAQ 100 has been doing even better. The bigger stocks that make up the S&P 500, that is the S&P 100, where they continue to outperform the rest of the stocks in the S&P. We look at the NASDAQ, which has done well, and the S&P, which has done well. But according to this ratio, the NASDAQ is doing even better. The NASDAQ 100 has been doing well, as has the NASDAQ, but the NASDAQ 100 has been outperforming the NASDAQ. The mega caps, the big companies that you usually hear about all the time, they are really outperforming when we look at the equal weight S&P 500 ratio. Then we look at the S&P 500 to small caps, and that's the red line, the ratio, and it's going down. And that's a bit of a warning sign. It's a little discouraging. In a good, solid environment, we want to see this red line going up because that gives support to the blue line, which is the S&P. Now, it can still go up without small caps, but it just means that the bigger companies are probably really providing any upside potential. For a broad market participation, we want to see this going up and see the small caps actually involved or included in any higher prices. Then we look at another ratio where it's showing that the small caps continue to underperform the S&P. We look at the 30 biggest software companies in the US. They generated a recent death cross, but they've been bouncing back. The longer they can stay above both of these moving averages, the more we might see a golden cross. These are the mega cap stocks, and these have been the real big performers in 2023, where they're really in a solid uptrend after seeing some weakness. They came down to their 200-day moving average, were able to bounce up off of that, and have been showing some strength since then. The robotics and AI ETF, a lot of people are really into this. It's showing some improvement here, but it's coming right back up into about the middle part of the rainbow. But when we look at it on a ratio basis and compare it with the tech sector, it's really been underperforming. It might be showing a little bit of an improvement here, but it's not really outperforming the way some might think it would. We look at the Dow Jones Composite Average, which is the Dow, the transports, and utilities all put together as one average index. And this has generated a recent death cross, but we're starting to come back above the moving averages now, so we're seeing some improvement. We look at the broad market and compare it with 3 to 7 year bonds, and it's showing that stocks are outperforming bonds, and we're seeing a lot of an improvement here with this ratio. We look at the S&P 500 and compare it with shorter term bonds. That's also starting to show a lot of improvement. We look at low volatility stocks, which are still in a downtrend, even though they've been bouncing up lately. Over the past week, we just saw everything go up, especially after the CPI report came out. Well, in 2022, these stocks, they may not have gone up all that much, but they didn't go down as much as some of the growth stocks. And that's why people like these kinds of stocks when the market runs into trouble. But it's still in a downtrend. We'll have to see. Is it going to go above its moving average, or is that going to act as resistance and start to come back down? We look at a ratio between the S&P 500 and the low volatility ETF that we just looked at, and it's really starting to break down to new lows here, showing that the low volatility stocks are underperforming. We look at the tech sector and compare it to 3 to 7 year bonds, where the tech sector is clearly outperforming bonds. We look at the S&P and then some other stock studies that we look at. This is the advanced decline line studies, and I often show this in the daily video. At the top is the NYSE common stock. That's just the stock like Microsoft, out. When you buy and sell stock, you're buying and selling common stock at that point, because there's lots of other things that are measured on the NYSE. We are seeing some improvement here, coming above the moving average, but the moving average is still going down. Also seeing some improvement with the S&P and the mid caps. We're seeing a little bit of an improvement here with the small caps, but they're still below a declining moving average. And we look at traditional Dow theory, which usually only looks at Dow and transports. Well, the Dow was down in Friday's session, where transports were up. And then I add utilities to the whole mix, where they saw a bit of a bounce after they have been showing a lot of weakness as of late. We look at some ratios. In a good, solid environment, we want to see the transports outperforming the S&P, really going up with this ratio. That's not what we're seeing right now. So that's another warning sign. And then we take another ratio between the Dow and the transports. When this ratio is going up, the Dow is outperforming. When this is going down, the transports are outperforming. And right now, they continue to underperform. We look at the relationship between the S&P 500 and the transports, and it's still pretty high. There's a strong correlated relationship between the two. And this is a new take on Dow theory, where instead of using the Dow, we look at the S&P, and instead of using the transports, we use the NASDAQ. We look for divergences and convergences here, and they're pretty much converging with each other. There's nothing really out of the ordinary that I can see on this chart. If we really break out with one index above these previous highs, but not with the other index, that would be a warning sign. But right now, they're pretty much going hand in hand with each other. The FANG index, Facebook, Amazon, Apple, Netflix, Google, and some other ones, I just keep calling it FANG. This one's been holding up fairly well. It has a really nice looking pattern on the chart here. We're above the 50-day moving average, and we're also in a longer-term uptrend. Here's a longer-term look at the FANG index. We're coming back and could possibly retest this all-time high on an intraday basis. We haven't quite done that yet. There was one positive thing that happened is we broke above this green trend line, because I connected this high to this high. We got above that, but we still have not been able to get back above the all-time high and set a new one, at least yet. ARC, a lot of people are in that. It's still in a downtrend, but it did have a good week this past week where it's seeing a bit of a bounce. Then we look at the S&P 500 and compare it with a monthly chart of different stocks throughout the world. We look at stocks in Europe, Australia, Asia, and the Far East. We're above the moving average, which means the S&P is outperforming. And then we look at what is the momentum of that ratio. And even though it's rolling over just a little bit, it's still above zero and it remains positive. We look at bonds to stocks. This is a total bond ETF, which continues to be in a downtrend, even though it's been bouncing back up. Then we look at world bonds, which came down and kind of tested this previous low here and have been seeing an improvement, but we're still in a longer-term downtrend. We look at a monthly chart of the stock to bond ratio, showing that stocks are outperforming bonds. Then we look at another daily chart showing how bonds are underperforming stocks. We look at high yield corporate bonds, which another way you can say that is junk bonds, and they tend to follow the stock market. And even though they saw some weakness, they have been making a comeback and they're still in an uptrend. We look at more conservative bonds, which are investment grade bonds, and they continue to be in a downtrend, even though they've been bouncing up lately. We look at a ratio between the riskier bonds like junk bonds and more conservative bonds like government bonds, and folks are still tending to prefer the riskier bonds because they give kind of a substantial yield that is higher than government bonds. They're willing to take on the risk to get the better return in those bonds. We look at a correlation between stocks and bonds. So the bonds based on price and stocks based on price, they have a pretty strong correlated relationship. So if stocks are going up, bonds are probably going up, and the inverse of that is also true. We look at the Dow Jones Corporate Bond Index, where it's still in a downtrend, but it has been seeing a bit of a recovery lately, actually enough to get above its 200-day moving average. We look at the 10-year yield, which hit the 5% area and then since has been falling back. We're wondering, are interest rates going to continue to go down? This is the real benchmark for the U.S. market. We also look at a longer-term look at the 10-year Treasury yield. For a long time, over 40 years, we were seeing a series of lower highs and lower lows as interest rates kept going down, down, down. We're watching this. We don't have an answer to this right now, but we seem to be switching over to a higher interest rate environment. We look at the 30-year yield, which has been coming down lately. And then we look at the S&P 500 and compare it with the rise or fall in interest rates, where the S&P was underperforming, but now it's starting to come back up and actually outperforming, but longer term, it's still in a downtrend. So that means the S&P has been underperforming the rise in interest rates. We look at junk bonds, which again have fallen back and are seeing a little bit more of an improvement here. We look at a ratio between junk bonds and government bonds, and they are outperforming even though they came down to their 50-period moving average. We look at the 7 to 10-year Treasury bond ETF, which is showing a little bit of an improvement here. We're working off of a death cross, so the longer-term trend is still down. But when we look at the RSI, we're above 50. That's shorter term, and a shorter-term momentum measurement here, as studied here by the MACD, that is showing that we're showing some improvement based on price. We look at a daily chart of the Treasury yields where we have been going up overall across all the different maturities. Lately, interest rates have been coming down, and that's giving some support to stocks. Here's a weekly chart looking internationally where we have the US and the UK with the highest rates right now, followed by Germany. And the Japanese rates are quite a bit lower, but they have been coming down lately. The reason why they are lower is there's a situation in Japan that I know about and I'm keeping an eye on, but I'm not talking about it unless it actually comes to the surface. Then we look at the MOVE index, which measures the volatility of bonds, and that has been declining. We look at the VIX, which measures the volatility of stocks. That's also been declining. And the relationship between the two is kind of neutral at this point. We look at a monthly chart of the price of the Treasury, the 30-year Treasury ETF, where it continues to be in a downtrend. And when we compare the price of bonds with the CRB ratio, remember, this is a monthly chart, so it takes a while for this to change. It is showing some weakness with bonds, but it's still in a longer-term uptrend compared to commodities. We look at different sectors, and we compare them to the S&P, where materials are in a downtrend and underperforming the S&P. Communication, which has been a stronger area in 2023, that's outperforming. The energy sector was really trying to make a comeback. We had enough here to generate a golden cross, but now we've been seeing some weakness in energy compared to the S&P. The financials, which really took a dump back in March when we had the banking crisis and have pretty much been going sideways ever since. We look at the industrials, which are in a downtrend compared to the S&P. Tech, which has been a stronger area in 2023, that's outperforming. Staples, which have been weak in 2023. Real estate, which had a good week this past week, but is still in a longer-term downtrend when you compare it to the S&P. And utilities also have been under a lot of pressure as interest rates have been going up. We look at a ratio between the S&P 500 and the utilities. When this is going up, typically the S&P is going up. When this is going down, the S&P is going down. Right now, we're chopping around right now. It has been going up lately a little bit here, which could be giving good support to the S&P. We look at healthcare, which has also been underperforming the S&P. Here's another chart also showing how it's in a downtrend. And then we look at discretionary, which has been a stronger area in 2023. It's trying to make a bit of a comeback here. But once we got into the summer months, it was chopping sideways and actually showing some weakness. So that's a little bit discouraging. We'll have to see if this can continue to improve. We look at staples, which these are things that you have to have no matter what's going on economically. They continue to be in a downtrend, but have been bouncing back lately. The tech sector is continuing to be strong and is in an uptrend. We look at the semiconductors, which had some weakness, actually fell below their 200-day moving average, but now have been really making a comeback. We do a ratio between the tech sector and the S&P 500, showing that tech is outperforming. And then we look at the energy sector and compare it with the tech sector and do a ratio. When this is going down, that means that energy is underperforming. It started to make a comeback, but now it's back to underperforming. It looked like we were going to get a golden cross here with this ratio, meaning that energy was outperforming tech. But with this recent weakness in energy, we might have avoided that golden cross. We look at the growth areas of the market, buy low, sell high, and compare it with treasury bonds, which are ultimately safe, especially the government bonds, and the growth areas of the market are underperforming the more conservative bonds. We compare the tech sector to the 10-year treasury yield, showing how the tech sector has been underperforming the rise in interest rates, but now starting to make a comeback. Here's an inverse of that same chart where interest rates were outperforming. Now they're starting to see some weakness. Discretionary to staples. Discretionary is more growth oriented, where staples are more value oriented. And discretionary continues to outperform staples. And in a lot of cases, you have to be a little careful because it doesn't mean that discretionary is doing well. It might mean that staples are doing bad. And on a relative basis, discretionary is holding up better. And that's kind of what's been happening later in the year. If we can see discretionary really start to improve, that would make this ratio go up. Here's an inverse of that same chart showing how staples have been underperforming discretionary. We look at a ratio between gold and the S&P, where when everything blew up in Israel, that really started to spike up. Now it's starting to come down, and the ratio is in a longer-term downtrend. We also compare gold to the U.S. dollar, which is continuing to underperform, even though the dollar had a weak week this past week. How's that? High leverage loans. I always say this in every video. If we were getting ready to fall apart economically, this would not be going up the way it is right now. These are risky loans. And you have very smart people that invest in this BKLN. And if they were really freaking out about what's happening, they would be selling, not buying, and driving prices higher. We look at the NYSE composite, which did generate a recent death cross, but it has been bouncing back up. International stocks also in a weak uptrend, but they have been able to break above both moving averages and are showing some improvement. Emerging markets continue to be in a downtrend, but they have been bouncing back lately. The micro caps, actually, by the end of the week, they were able to close above the 100 level. They didn't set any recent new 52-week lows, but they did drop down the week before when we were running into some problems. We do a study between the S&P 500 and the Home Builders ETF. This is a highly interest rate sensitive environment. When the S&P is going up, that's the top area. Then we look at the Home Builders ETF, which has been going up. Here's a ratio between the two, and we see that there's a strong correlation. When we really take notice of this is when this drops really down to this dashed line and these previous yellow areas. That means there's a divergence going on here, and something's going to have to give. Either the home builders are going to have to get stronger or weaker, or the S&P is going to have to get stronger or weaker. We keep an eye on Bitcoin. I was going over this in the daily chart, mainly because we are coming out of a positive seasonality time. I stopped doing that, so I'm only going to show the chart here in the InterMarket Analysis video, where it has shot up. We got up to the 38 area, We did see a recent golden cross here with Bitcoin, but it's been pulling back lately. And we look internationally, this is using the KST, which is a momentum oscillator, and we're seeing pretty much across the board strength here, especially when you compare the S&P to different countries. Then we look at an intermarket analysis chart going back to the beginning of 2023. Stocks have been performing the best, followed by gold and then the dollar. Oil, which had gone negative, has now dropped back up into the positive side of things. But since the beginning of August, we've been seeing the price of bonds be negative for the year. We also look at some correlations. We compare the S&P to the dollar, and they're having a tendency to go in opposite directions. So if the dollar's up, that could put pressure on stocks. If the dollar's down, that could give support to stocks. Then we look at oil to the S&P 500, which is working its way back to neutral, but they're having a slight tendency to go in opposite directions. We look at the S&P to the 10-year yield. They're having a pretty strong tendency to go in the opposite direction. So if you look at the 10-year yield and it's up, that might be pressuring stocks. Then we look at the tech sector and compare it with the 10-year yield. If that's the yield's going up, the tech sector might be having some problems. Then we look at the 2-year yield to the S&P 500. They're also having a pretty strong tendency to go in opposite directions. We look at some long-term trend studies here. This is a monthly chart of the NYSE where it was able to get back above its moving average. That's longer-term positive. And the Kopic curve, which is a momentum oscillator, it is turning back more positive. So in the longer term, in the broader market, we are showing an improvement. Then we look at a daily chart of the NYSE composite and compare it with the record high percent index. This had been showing some weakness as the market's been under pressure. It's now starting to turn back up. We look at the S&P and then look at the momentum where we're above the moving average on the top and we're starting to turn back up with the percentage price oscillator. We do a ratio between the S&P and the CRB. This is showing that stocks continue to outperform the CRB index, even though for a lot of 2023, the CRB has been in an uptrend. And then we look at the S&P 500 and look at another global index on a monthly chart. We're above the moving average on top. That means the S&P is outperforming the other stocks in the world. We're seeing a bit of an improvement here with the KST, which is a momentum oscillator, but it hasn't quite crossed over positive, at least yet. Then at the end of each video, I take those things that are positive and negative and put them in a list. My definition of positive is when the 50-period simple moving average is above its 200-period simple moving average. Now, I know there's a lot of different ways to do this, but this is a generic way of measuring positive from negative. We have the CRB index, which is positive, the dollar, mega caps, the FANG index, bonds when you look at high yield and junk bonds, the riskier bonds, the tech sector and semis, high leverage loans, the Dow, which this past week, it actually did generate a death cross. But then the Dow had some good days and it was able to get above both of those moving averages. And we were only for a very short period of time, we then went back and generated a golden cross. The NASDAQ and NASDAQ 100 are in uptrends and all stocks, and then Bitcoin is in an uptrend. Then when I look at the negative side of things, this is when the 50-period simple moving average is below the 200-day simple moving average. We have the growth indexes and value indexes. Even though growth is outperforming value, gold and silver are in downtrends. Copper, the Japanese yen, the euro, and the British pound to the US dollar are all in downtrends. The big software companies, although they're showing some improvement, they're still longer-term negative. The Dow Jones Composite Average, the Low Volatility ETF, ARK, as well as the NYSE, Staples, the Total Bond ETF, World Bonds, and then we look at the mid caps, small caps, and micro caps. It's the bigger indexes that are actually holding up better. And then we have emerging markets, which continue to be in a downtrend. So thank you. I hope you found this helpful. This is not meant to be necessarily a standalone video. I would ask you to consider checking out the daily videos that I post, and I also post a weekly video. After this, I will also be recording what I call the deep dive video, where I go through all the daily charts that I really didn't talk about in any of the videos this past week. I hope you have a great weekend, and I will talk to you in the next video.